Wealth is often indicated by the accumulation of income-generating assets rather than just high income. One common indicator is owning multiple rental properties, providing consistent passive income streams. A diversified portfolio of dividend-paying stocks also signifies wealth through regular return. Possessing a fully paid-off business represents significant asset ownership and reduced financial burden. The absence of consumer debt is a crucial indicator, reflecting strong financial management. These combined indicators culminate in financial freedom, where assets cover living expenses. Investment strategies fundamentally differ in their approach to market engagement. One primary strategy focuses on actively beating the market through frequent trading. This often involves daily trading, attempting to capitalize on short-term price fluctuation. The objective is to outperform market averages by selecting specific assets or timing trades. Conversely, another strategy advocates simply buying and holding the market. This passive approach typically involves investing in broad market indices for long-term growth. Long-term holding is an investment philosophy centered on sustained ownership of assets. This strategy emphasizes acquiring shares in fundamentally strong businesses. It prioritizes the enduring value and growth potential of companies over short-term fluctuations. Market timing is generally considered less effective than consistent, long-term ownership. Compound interest is a financial principle where interest is earned on both the initial principal and accumulated interest. It differs from simple interest, which is calculated only on the original principal amount. This mechanism allows investments to grow at an accelerating rate over time. The accumulated interest itself begins to earn interest, creating a compounding effect. This exponential growth significantly contributes to long-term wealth accumulation. Long-term investing is a strategy focused on holding assets for extended periods. This approach allows investments to benefit from compounding and market growth over time. The primary goal is to achieve significant appreciation and consistent returns. It contrasts with short-term trading, which seeks quick profits from market fluctuations. Patience and a focus on fundamental value are key tenets of long-term investing. Capital preservation prioritizes safeguarding initial investment capital. It focuses on strategies to mitigate the risk of significant financial losses. The primary goal is to protect the principal amount invested. These strategies aim for growth while minimizing exposure to downside risks. The fundamental principle of financial management is to spend less than one earned. This involves systematically allocating a portion of income towards savings. Subsequently, these savings are strategically invested to foster wealth growth. This disciplined approach prioritizes financial security and future growth. Lifestyle upgrades are considered only after savings and investments are secured. Financial discipline involves the strategic allocation of income towards savings and investments. This approach prioritizes setting aside a fixed percentage of earnings, such as 20%. These funds are designated for savings and investments as a primary financial commitment. This allocation is treated as an essential expense, not as residual or leftover funds. Such a disciplined method ensures consistent growth of personal wealth over time. Investment prioritization involves strategic allocation of financial resources. The core principle is to favor investment growth over immediate consumption. Financial resources are first directed towards enhancing existing investment portfolios. This approach aims to maximize long-term wealth accumulation and financial security. It contrasts with using funds for lifestyle inflation, which offers short-term gratification. Prioritizing investments builds a stronger financial foundation for future prosperity. The principle of paying yourself first is a foundational concept in personal finance. It advocates for prioritizing savings and investments over other expenses. This means allocating a portion of income to savings immediately upon receipt. Savings are treated as a mandatory expense, similar to rent or utilities. It contrasts with saving what is left over after all other expenses are paid. This approach fosters consistent wealth accumulation and financial security. A key financial strategy involves the acquisition of cash flow generating assets. These assets are specifically chosen for their ability to produce regular income streams. Examples include real estate properties that generate rental income. Another example is dividend stocks, which provide periodic payments to shareholders. This approach focuses on building wealth through consistent, passive income generation. This scene compares the financial outcomes of purchasing a luxury depreciating asset versus an income-generating asset. A luxury car typically loses significant value immediately after purchase and continues to depreciate over time. Conversely, a rental property is an income-generating asset, providing consistent revenue through rent. Rental properties often appreciate in value over the long term, building equity for the owner. The comparison highlights the long-term financial benefits of investing in income-generating assets over depreciating ones. This strategy focuses on the systematic accumulation of dividend-paying stocks. Investors consistently purchase shares of these companies on a monthly basis. The primary goal is to build a portfolio that generates regular income through dividends. This approach emphasizes consistency and long-term growth of income stream. It provides a disciplined method for wealth accumulation and passive income generation. Passive income is earnings from an enterprise in which one is not actively involved. It is generated by assets that produce income with minimal ongoing effort or management. Examples include rental properties, dividend stocks, or royalties from intellectual property. This income stream contributes significantly to achieving financial independence. Investment strategies often diverge based on fundamental philosophies and objectives. One approach emphasizes ownership, focusing on acquiring and holding assets for long-term growth. This ownership-centric philosophy prioritizes asset accumulation and intrinsic value. Conversely, another philosophy centers on market volatility, engaging in speculative trading. This volatility-focused strategy seeks to profit from short-term price fluctuations. These two investment philosophies have distinct goals and methodologies. Protecting the downside is a fundamental principle in financial management. It emphasizes the critical importance of safeguarding capital against potential losses. Retaining capital is a key skill, particularly in volatile market conditions. Minimizing losses allows for continued participation and recovery in the market. This strategy focuses on risk management rather than solely on maximizing gain. Prioritizing capital preservation ensures long-term financial stability and growth. Leverage involves borrowing capital to increase potential returns on an investment. While it can amplify gains, leverage also significantly magnifies potential losses. A small market downturn can lead to substantial financial setbacks when leveraged. Avoiding leverage is a fundamental strategy in prudent risk management. This approach prioritizes capital preservation over aggressive, high-risk growth. Hype cycles represent periods of intense speculation in certain assets or technologies. During these cycles, assets become overvalued due to irrational exuberance, not fundamental worth. Investors, driven by fear of missing out, often pour capital into these inflated markets. This speculative behavior frequently leads to a market bubble, unsustainable in the long term. Ultimately, these bubbles burst, resulting in significant financial losses for those invested. Effective risk management in investments hinges on a fundamental principle. Investors should only allocate capital to assets they thoroughly comprehend. This approach significantly reduces risk by avoiding unfamiliar financial products. Understanding an investment's intricacies is crucial for informed decision-making. Risk management prioritizes safety and stability over aggressive, high-return strategies. This approach focuses on mitigating potential losses and preserving capital. Conversely, pursuing rapid, high returns often involves elevated risk exposure. A conservative, risk-managed strategy typically leads to more sustainable and enduring wealth accumulation. Compounding returns illustrate how an asset's earnings, from either capital gains or interest, are reinvested. These reinvested earnings then generate their own earnings, creating a snowball effect over time. Initially, the growth of wealth may appear slow and incremental. However, as the investment period extends, the rate of wealth accumulation accelerates significantly. This exponential growth is a core principle in long-term financial planning and investment strategies. Therefore, allowing sufficient time for compounding to work is crucial for maximizing wealth generation. Market volatility is a common characteristic of financial markets, causing price fluctuation. These fluctuations often lead to emotional reactions from investors, particularly during downturns. Impatient investors tend to panic sell during market declines, locking in losses. This behavior results in a transfer of wealth from those who sell impulsively. Patient and disciplined investors, conversely, maintain their positions or buy during downturns. Their patience allows them to benefit when markets recover, accumulating wealth from the impatient. Market downturns, often perceived as threats, can present unique opportunities for investors. These periods are reinterpreted as discount seasons for strategic long-term investors. During these times, asset prices fall significantly below their intrinsic value. This allows investors to acquire high-quality assets at reduced costs, maximizing future returns. Financial freedom is primarily achieved through strategic asset ownership. It is driven by the income generated from these assets, not solely by high active income. Reliance on active trading alone does not define true financial independence. Sustainable wealth builds upon a foundation of income-generating assets. Financial markets ultimately reward consistent discipline in investment strategies. Patience is crucial, allowing investments to mature and strategies to unfold over time. Systematic approaches to wealth building outperform speculative or impulsive actions. This disciplined methodology leads to compounding benefits, enhancing long-term financial growth.